Three, two, one. Welcome to the show remotely from
All right.
super disclosed
Welcome to the show.
locations. I am in DC, Jerry's
Very
up in
cool.
Massachusetts, and hopefully we got rid of that delay that we had last time in the show. A lot of people noticed it, but that's show business. It's Hollywood.
Yeah,
Sometimes
sure.
it happens.
Hopefully it's better.
Yeah, I
Yeah,
think so. Looks like it is. But what you got
sounds a
for us,
lot better
man?
on my side. Well, the bull market marches on amazingly. Uh, I think a lot of people are kind of dumbfounded that it's continuing the way it is, but we'll kind of get into it. I got a hodgepodge of things to go over today, and
A hodgepodge.
uh, hodgepodge. Yeah, and you and I are going to talk about some of the stuff. So, upcoming Fed meeting, talk about that real quick, and then I got a bunch of Twitter screenshots that I did, and I'll point out, it's basically to give you guys some um, an idea of some of the Twitter, some of the guys I follow on Twitter, and what they're saying. It's easy now to find bulls, where this time last year it was impossible to find anybody that was bullish on the market. Now it's actually more difficult to find people that are bearish on the market. But we'll take a look at actually some of both. And then
I need some
the
of those
bonus
guys to
chart
move over
is
to Threads so I can follow them. As I'm not on
threads.
Twitter.
Yeah, I don't. Financial services is all about Twitter, so it might take a minute for those guys to get over Threads. Um, and then bonus chart is going to be Dow Jones Industrial Average. Is a really really good chart setup that's going on right now in the Dow Jones Industrial Average. And then we'll look at the weekly TSP fund charts. So before we get to all that, we had a question in. I think it went to support at Grow My TSP. Um, earlier this week. It says, can you guys make recommendations for members that want to do more than TSP, specifically which companies to use? Fidelity, Vanguard, Schwab. Thanks. Keep up the great work. So you guys know, obviously, I'm up here at my parents' house. I'm up in Boston. Boston is the hub of Fidelity. And so I've had a Fidelity account forever, and they make it very simple. You can trade your own stuff, or you can get them to do kind of trades for you if you want. I'm sure Vanguard and Schwab have the same kinds of options. You can do rollover 401ks, regular IRAs, regular brokerage accounts in all of them. And the fees are all generally similar. If you buy the Fidelity, S&P 500 fund, it's cheaper than if you were to buy the Vanguard S&P 500 fund in a Fidelity account, for example. But they're all pretty similar. I'm not sure that I would have a big opinion one way or the other. I think Vanguard is probably bigger than Fidelity overall, but I was just more. I kind of grew up in Fidelity, so that's where I'm at.
So I had a
Do you
little
have
bit
any
to that.
opinions?
When we started kind of looking around where to put our IRA money, when we did some rollovers and stuff, personally, one of the things that I noticed most of all was that the lack of the ability to do fractional shares. Right, so Fidelity allows you to do pretty much every one of their ETFs. You can do fractional shares, and there's an ETF that covers just about anything you could possibly want to invest in. So that's pretty handy. Um, the Schwab has a thing called slices, which is a version of fractional. I think it's called slices. They don't call
Yeah.
it fractional trading, but anyway, but it's a lot more limited. And then I don't know if Vanguard does, but at the time that we looked at it, they didn't. A lot of people are trying to do that because the consumers want it. But I will add that is a big frustration. Now, if you've got a large pot of money, does that make as big a difference? Maybe not. But if you're wanting to, trade, if you wanted to do kind of like what we do, which is percentages, right? Balancing your portfolio. And like if you were following our model, it does get difficult to do if you have to buy full shares. If you can buy fractional
Yeah.
shares, you can do the percentages easier than you can, whole dollar amounts. So just wanted to add that for people's thoughts. I'm a big fan of Fidelity also because of that same reason. And so that's where I ended up at. I tried TD, American Trade, which is also now bought by Schwab, although oddly enough, TD doesn't allow fractional or slices or whatever they call it.
Yep.
So yeah, I mean I think that's pretty much, other than the fact that you were already familiar with them, Jerry. I think other than that, that was a big bonus, right, with Fidelity. So
Yeah, that is a bonus. And kind of going back to what you're saying, you really can't do the percentage the way we do it in an IRA. You have to actually buy and sell. You can't just reallocate. So that is one of the good things about TSP is you can just change the reallocations rather than actually buying and selling the shares.
yeah, and there's a delay, right? I mean, so you
Yeah.
you have to sell your position in one thing. Let's say you're 50%, whatever the ETF is for a particular index, right? And then you're 50% something else. Well, you have to sell that, wait for the transaction to happen, and then buy. Unless you set up a margin account, right, which is kind of like borrowing money,
Right.
which most people aren't going to do. So yeah,
Yeah.
it's very possible. Obviously, we talk about it all the time. Managing your IRAs and doing things outside of TSP, but these are the little things that it's great to not have the 2 moves a month and the noon rule.
Yep.
Right? We can trade as much as we want, but you still have issues where it's not it's not immediate per se. Like it's not, you're not day trading in an IRA really. Those transactions don't happen that fast.
Right.
So you're
Right.
still kind of limited sometimes. And so that's something to keep in mind for folks that want to do that.
Yeah, it definitely takes more work. I mean, you have to get into it and kind of know what you're doing. It's not a whole lot more. I mean, if you're following it based on our methodology, you have the methodology. It's just that whichever company you choose, Vanguard, Schwab, Fidelity, any other one, you have to work their little nuances. That's all.
Yeah. And I would urge people really to consider, not trying to day trade. We call it day trading.
Sure.
That really means intraday, right? You're trading within the day. I don't even mean like look at it daily. Like manage it weekly. Make your life simple. Accept a little bit of up and down in there, and just be in there for the long haul. It's not worth the anxiety and the stress, and you're not going to get that much better performance out of it. It's quality of life as much as it is quality of your IRA account, right?
Yeah. Yeah, 100%. Weekly charts are a way better way to go.
I mean, it's the way that most, if not the majority of, investors, people that manage money, are not managing the money daily. They're watching the market daily, for sure, like we do. But if you're going any smaller window than a weekly, right? You're just on the whim of the market, you know.
Yeah. And especially, we have the 2 move a month rule in TSP, but like you said, it takes time for those buy and sell orders to execute. And I think it's up to 48 hours. And so you're not going to be able to use that money if you sell SPY, which is like the C fund ETF, and you go to buy VXF, which is the Vanguard S fund ETF. You're not going to be able to sell and use the same money right away.
Right, you can't move it around that quickly.
Right.
We've run into that. I mean, I have run into that using our methodology, even making my changes in sequence with what we do in our TSP account. Even then, it just doesn't happen that fast. It's pretty fast. I mean, I would say within the 24 hours, I'm usually able to kind of make those moves, particularly if I do it early enough in the day.
Yep.
But yeah, I mean, so that's still a restriction, and people that
Yep.
kind of flip out when we send out an alert or whatever, and then you get tomorrow's or that day's closing price, and that's about the best you can ask for. And some days, oh, you missed it, so now you're going to get tomorrow's closing price. Well, that would basically happen in a regular IRA anyway, you know.
Yeah. Yeah. I
So
mean, if you're trading ETFs in your IRA, at least you're going to get, the price that you sell it at. You're going to
right,
get that price.
it's not going to
But
be the closing. Yeah, exactly. It's going to
right.
be when it. That's the nice thing, is it happens when you push the button. Now the transaction may take a while, but at least you get that
Right.
price. So
Right.
that's a lot better.
All right. Well, hopefully that helps with that one question. Good question. We always like to get them. Okay. So we got FOMC, Federal Open Market committee meeting this week coming up, 26th and 27th. 27th, I think, is Thursday. So the Fed chairman will be out on Thursday, and virtually everybody expects rates to go up another 0.25%. And there's a whole bunch of talk about that on the internet. And the first chart kind of pulls together a whole bunch of things that I thought was interesting about that. So from Christian Linwood, price of silver ounce on Twitter. So the Fed will almost certainly hike interest rates next week. This could add accelerant to market downturn. So that's opinion, right? This is a bearish opinion. That's fine. Silver and gold will crash with the market. That's opinion. That may or may not happen. Probably a great opportunity to add to the stacks, he's saying, on a pullback. But what's interesting about all this is he overlaid a whole bunch of things on this chart. So the fear and greed index is in there. Fear and greed has been in the 80s for the last 2 weeks, which is really unusual. The retail investor is all into this bull market, and a lot of times, in retrospect, eventually when the market does roll over, which it will, people will point back and say, "See, I told you, fear and greed index was high, and the market rolled over." But it's been there for the last couple of weeks, and the market keeps going higher. So there are a lot of indicators that the market is toppy right now, but it can go a lot longer. Just because it's overbought doesn't mean it's time to sell it. And so it's like playing Jenga. You start pulling the things out, and sooner or later the thing's going to fall down. But it can take another bunch of turns around the board before that happens. It's until it really starts to roll over, it hasn't. So, but there's a 99.8% expectation that, or probability, right, rate target probability for the next meeting that the Fed's going to raise 0.25%. And so that means it's already priced into the market. So if the Fed does raise 0.25 point, it's unlikely to affect the market very much. If they do something other, whether they continue to pause, which they paused last month, if they continue to pause, that might generate some movement. If they raise rates 0.5 point, that would probably definitely generate some movement in the market. But 99.8% of analysts think that they're going to raise by 0.25 point. So that's next Thursday. It'll be interesting to check that out. Okay, so just like a hodgepodge of stuff. Charlie Bellio does not tend to be bullish. He tends to be bearish. But this is staying on the Fed rate hike kind of line of thought. Here we are, July 23. The expectations going forward, right? Fed hikes 0.25 point right there. Expectations, vary, and rates may continue to go up because the Fed said it was going to raise 2 more times this year. So maybe it raises in July. And then again, I think the next one is September. But the point of this chart is the market is expecting, once we get the second rate hike this year, maybe we pause for a month or two, or one or two Fed meetings. But then they're expecting a pretty consistent cutting in the market in Fed funds rate, and they're talking about cutting, getting down pretty low here by January 2025. So the market is definitely pricing in the Fed to begin cutting rates, and I think the majority of people that I follow think that the only reason the Fed would cut rates is if something broke in the economy, and they were kind of trying to rescue it and cutting rates pretty quickly. So I tend to go along with that rationale, because the best thing the Fed can do is have rates as high as they can go, so that when they start cutting, they don't have to cut really low to have an effect. So I don't know why the market would be pricing in rate cuts when employment is really low, and there's a whole lot of positive things that you can point to. So it's going to be pretty interesting in terms of rates going forward for the next at least a year. Okay. So some of the Twitter stuff, Tom Lee, we've talked about him before. They call him the perma bull on Wall Street. He's really, really smart. He's been very accurate this year. But the reason I'm putting this up is because this week Tesla came out with earnings, and he's like, I'm watching for tech to dive. And it certainly did on Thursday this week. Tech in general was down. Tesla was down. All the FANG stocks were down on Thursday, but the rest of the market stayed pretty much flat to up, which is good for us because the indexes, where we don't have a FANG or just a tech component in TSP. We saw S fund go down a little bit, but the broader market did not. So the fact that tech by itself kind of took a hit on Thursday and everything else held up is good for us in terms of the indexes. But the interesting thing about this is you never see Tom Lee tweet anything bearish. And that's why I pulled it up, because we got that this week. JC Peretz, talk about him all the time. He's very bullish, right? So he's saying the last time, you can look at all these charts in different ways. And so he's saying the last time fund managers were this bearish on commodities, crude oil futures literally trading below zero. So back here in 2020, if you remember, oil was actually negative. It was kind of crazy. And this is what he's saying here is that when the expectation, when everybody's bearish, you want to be on the other side of the trade. And so what he's saying here is that the last time, oil futures were at zero was the best time to buy it. But in the chart, the analysts are very underweight commodities. And so everybody thinks commodities are going to crash from here. And JC is saying that this is probably a good time to think about buying commodities. Another one from JC, this is pretty interesting. The Dow Theory, the original Dow Theory, it's from the 1800s. And the idea is that when the Dow Jones Industrial Average hits a new 52-week high, and it gets confirmed by the Dow Jones Transportation Average and hits a 52-week high, a bull market is underway. That's the definition of a bull market in the original Dow Theory. And so he's pointing it out because there are still a lot of people that are negative on this market, and the Dow Theory tends to be late. So by the time you have a new 52-week high in the Dow Jones Industrial Average and a new 52-week high in the transports, it's a real confirmation that a bull market is already underway. It tends to be a late signal. It's more of a confirmation than a signal. So he's pointing this out because there's still so many people that are bearish on this market. Okay, this one was pretty interesting, and it's going to the same point. Seeing similar sentiment data from hedge funds and other large speculators, Wall Street sell side too. So high net worth investors with more than $1 million investable have their highest allocation into cash per CNBC, which means people that have at least $1 million they're investing, they're still bearish the market, right? Because their money is in cash. So they're expecting the market to roll over. And he's saying that when people are bearish, that's the market climbs a wall of worry. And so from his perspective, the market keeps going higher as long as these people are bearish. This was a pretty good one that you can look at from a couple of different ways. JC is pretty obnoxious, but he's saying, but the nice man on TV said it was only 7 stocks. So we've been talking for a while about how basically the FANG stocks have been driving this rally all year. And so what this chart is new highs divided by, or new highs minus new lows. So we are at a point where the vast majority of common stocks on the New York Stock Exchange have hit new highs versus new lows. So as you would expect back here, in the October low last year, the vast majority were hitting new lows, right? Not new highs. And now we're up here where most of them are hitting new highs. And so he's saying the point of him pushing out this tweet is that it's a lot more than just the FANG stocks when all these stocks on New York Stock Exchange are hitting new highs relative to new lows. The other way you can look at that is we're above 200 here, right? The last time we were there was when the market collapsed, right? So obviously the best time to get into the market would have been down here, because then you got this whole move higher in the market, right? And so you can look at it a couple of different ways. Either this is confirmation that more stocks are making new highs and therefore the market keeps going higher, or you can say, yeah, but the last time we had this ratio of new highs to new lows was when the market was at a top in 2021. So it just depends on how you want to look at the data. JC had been bullish back in October, back here. He actually said that the bottom of the market was in June, was the June low. And so there's a lot of this kind of goes to the divergence that we always talk about. So back in June was a low last year on the market. October was a little bit lower low on the index, right, on the S&P 500, but the ratio of new highs to new lows was higher in October than it was in June. So more companies were, it's showing a turn, right? It's showing a turn in the market. So even though price of the index was lower in October than it was in June, there were fewer companies hitting new lows than there were in June, right? So it's showing a turn in the market. And that's why he pretty early on said this is the bottom, this is the time to buy. And he was right. Okay. Ratio charts are really important. We haven't done them in a while. I'll probably do them on another show here coming up because they're really important. But what he's saying here is in strong bull markets, there's little need for the safety of consumer staples and low volatility stocks. So consumer staples are, like Johnson & Johnson, basically stuff that you need, not stuff that you want, right? So when we're in a bear market, people tend to invest in companies that will always sell in bear markets. And those are consumer staples. There's things that you need, not things that you necessarily want. And so if you do a ratio of consumer staples, right, XLP versus the overall index, XPY, if you're in a bull market, you expect the chart to be going down because less people are buying consumer staples, right? They're buying things they want instead of things they need. So if they're buying things they want instead of things, if they're buying things they need instead of things they want, then this chart will be going the other way. I'm kind of talking around that. Hopefully it makes sense. So what he's saying is we have a new 52-week low in what people need versus the S&P 500. So this means that people are buying what they want, and that's consistent with a bull market. And it's the same thing with low volatility stocks, because in a bear market, you want to buy things that are not volatile, right? In a bear market, tech stocks go down the fastest, so you don't want to buy them. In a bull market, you do want to buy things that are volatile, like NVIDIA and all that. And so the things that you don't want to be volatile tend to go down. And we're at a new 52-week low there. So the ratios are pretty important. And he's saying this is more evidence that we're in a bull market, not a bear market rally. Okay. Jim Bianco tends to be bearish, but this is just kind of data that he's putting out. He doesn't really put much of an opinion on this. The public is bullish on stocks, but professional managers are not. Okay. So AAII is the sentiment index for like retail investors. And so you got AAII, and then you have the Bank of America Global Equities Analysts. So the dark line is us retail investors. Okay. The light blue line is the Bank of America analysts. And so right now, us retail investors, we are all in on this bull market. The professionals are not. Okay, so we talked about it a couple of times. The professionals were wrong since the beginning of the year. And could they continue to be wrong? And the retail investor is right, and the market keeps going higher? Absolutely. But it's just good to know that the professionals are underweight this market. And so it's people say that we at Grow My TSP tend to be conservative. It's kind of with good reason, because the majority of the professionals are conservative right now. They're underweight the market. Okay. And Ryan Dietrich tends to be really bullish. He's one of the bigger guys in the chartered market technician world, but he does tend to be pretty bullish. So the most overweight area, cash, ? Right? So again, the question here was, what do you think is currently the most crowded trade? So he's asking professionals what they think, not what they're doing with their money necessarily, but what do they think is the most crowded trade? And cash is the most crowded trade. So most professional investors still think that cash is the place to be, right? And they're saying equities is the worst place to be. So they're saying that they think that the market is at a top, and it's very risky to be in the market right now. So again, take it for what it's worth. The professionals were wrong all year. Could they be wrong? Continue to be wrong? Yes, but possibly not. It's just, it's just not an easy game. And I think this is the last one. This was pretty interesting, I thought. After the greatest first half of the year in the history of the NASDAQ, sell-side analysts respond with their most bearish second half outlook on record. So he's kind of rubbing it in, right? Because he was right back in October to say that was the bottom and a new bull market was beginning. And he's saying that the experts are sticking to their guns and saying that the second half of 2023 is going to be really bad. Okay, so we'll see who ends up being right. As you know, we don't hitch our wagon to any of these horses. We respond to what the market actually does. Okay. I think this is the last one from JC. All right, so interest rates are going higher. This group has never bet so aggressively that bond prices are about to fall. And I actually fall into this category. The Elliott wave count, which we talk about all the time, and we'll talk about it again on the F fund, the count calls for prices to go down in bonds. But his chart here is saying that this is a chart of the 10-year yield, right? So yield goes inverse to the price of bonds. So yield has come down, came down, and he's saying that this is going to be the bottom. And so it starts going back up from there. Their commercials versus large speculators. So if you look at, let's say this bottom is pretty easy. So we had a bottom here in 2018 in yield, and the commercials, said it was a top, and large speculators had it as a bottom. So basically he's saying we're up here in the same place with the commercials, and we're down here at record levels on the large speculators. So he's expecting this to go up and this to go up. So we'll see how it goes. This group has never bet so aggressively that bond prices are about to fall. So we shall see how it goes. Okay. So that's basically a hodgepodge of stuff that I kind of look at on any given week. I try to take in as much on the bullish side and the bearish side, and put out some of the interesting stuff to you guys, just to kind of give you an idea of what I'm looking at, and some of the guys that you can look at, and that you can tell they're all very they have very good arguments for their opinions, and they're going to be, some of them are going to be right and some of them are going to be wrong. And from our perspective, the best thing to do is to know all those different come froms and then respond to what price actually does. Okay. So Dow Jones Industrial Average. This is one of the best chart setups that you could possibly see. Dow Jones, just like all the other indexes, came down for a low last October. Since then, so this is a weekly chart, right? Each one of these ticks is a week. The blue line is the 20-week moving average line. So since the low last October, the Dow comes up, puts in a really good head and shoulders bottom pattern. Okay. So you got left shoulder, head, right shoulder, and the neckline right here. And this week, we had a huge breakout to the upside through the neckline. So theoretically, by the book, the minimum target is the distance from the neckline to the bottom of the head should be the same distance from the neckline to your expected first target. So we're up here at around 37,500 on the Dow Jones Industrial Average. And the beauty of this isn't so much that since it's broke the neckline, we're expecting it to go up to 37,500. That's true, and that's good. It gives us a target on the upside. But the best thing about it is if it rolls over from here and breaks this neckline to the downside, you just sell it. And so this is your risk, and this is your potential upside. Okay, so if you are in the mutual fund window or in a brokerage account, you can find either an ETF or one of the fund symbols in the mutual fund window, and you can play that as a trade. But the pattern, that chart setup, is really, really good. Okay. All right, TSP fund charts. So C fund, we've been talking about this resistance level for quite a while. We needed to get above 4,200. We did that. We got above 4,300. The 61.8 retracement level was a big deal because that was the August high from last year. We got above that. And the next resistance level was the 786. And we are bumping into resistance at the 786. So to be expected, could we get a little bit of kind of pullback here, churning, and then break out and keep going? Absolutely, that's a possibility. Could we get some churning and come down and get support at that 20-week moving average line and then keep going higher? That's certainly a possibility also. As long as this 20-week moving average line is angling up, we're in pretty good shape. RSI is really strong. MACD is expanding to the upside. So there's no reason on this chart to be selling the C fund. But again, expect some kind of churning here before we break to the upside. And if we get some churn and we break to the downside, we're looking for support at that 20-week moving average line. S fund, pretty interesting. We had a breakout last week through that upper channel line. And like we said, the next and last big obstacle for the S fund is getting above that August high from last year. And that is exactly where it's hitting resistance right there. So the S fund is still in good shape, and we hope it gets up there above 1850, and then it's more likely to keep moving. But if it rolls over and gets back below that channel line, then it hasn't broken out of the pattern yet. But RSI has a long way to go before it's overbought, and it's going in the right direction, and MACD is expanding to the upside. So S fund is looking pretty good, even though it's struggling to get above resistance from last August. I fund, same kind of thing. We've been talking about the 74 level for a while. It's tried to get above it, and it can't seem to do it. Really big breakout last week at that 20-week moving average line, which was really good. But then this week, it's churning there and trying to get above that 74 level. So if all goes well, we get up above 74 and keep on going. But RSI is not looking as strong. It's hitting resistance there at the moving average of the RSI, that yellow line. Its overall angle is down compared to the S fund, where the overall angle is up. So I fund is not looking as strong, and obviously MACD is not as strong. So we'll see. And as we've talked about it a ton of times, it really depends on the direction of the dollar. Okay. And the F fund. So like I said, I'm in kind of one of those camps that JC is kind of laughing at. I'm expecting another leg down in bonds, just because of the Elliott wave count. This was the high back here. We have a 1, 2, 3, 4, and the next leg should be down in the F fund. I think we talked about it last week. That count is wrong if the F fund gets above this high. So if the F fund gets up here, say 101.50, if we did something like this, got above this level, then it's likely the F fund keeps moving higher. But until that happens, the primary Elliott wave count is that we have another leg down in bonds. Okay. That is all I got. Who's got questions?
As usual, if you have any questions, you can put them in the comments section wherever you find this video, whether it's on social media or YouTube or what have you. If there is no comment section, wherever you find it, then you can shoot us an email at support@growmytsp.com, and our support team will get it to us. That's how we got that question there in the beginning of the show. So it does make it to us, I promise. And a lot of times we won't always put stuff in the show that we answer the question, but if it's something we think is, related to, that everybody will get some value out of it, we like adding that to the show. So we appreciate the comments and we appreciate the questions because it helps us give us stuff to talk about.
Exactly.
All right, guys. Hope you have a great week coming up and hope your weekend has gone well. And we will see you next week.
Alrighty.
Cue music. Let me find the thing.
Don't.